So let's give asset protection a little bit more attention. As I explained in the introduction, asset protection speaks to being able to create a buffer. It's basically ring fencing your assets from each other, from yourself, ensuring that liability on the one side can never affect the other, right? Now, again, this is very intuitive, but the legal nature behind it, I believe, is what may make this concept slightly overwhelming to most, really. Because the reality behind it is, what do we understand about structures? What do we understand about the ever-changing landscape of South African law? And how these structures are actually created or governed, and whether they do really offer asset protection, or what risks are associated with it, what exceptions are there to this. So we're looking predominantly at three primary vehicles when we speak about asset protection. Now, when I say vehicles, you in your personal capacity are still considered an investment vehicle. Strictly speaking, it's not a vehicle in our law, but it's a conduit, it's a manner of investing. Now, the three vehicles are you, your personal capacity, your company, and your trust. Now, these are the three primary ones that we use. Yes, in our law there's a couple others, but for our purposes today, we don't really need to focus on this. Now, between these three vehicles, what are we going to be looking at to ensure that you have the best structuring possible? So let me start off with you in your personal capacity. Is this the ideal vehicle to use, and why? So in your personal capacity, there's some great benefits to it. I mean, from a tax side, Shirley Boy will mention that depending on what your tax rate is, you may actually find that you pay very, very little tax in your personal name. But there's better ways of doing it. There's ways of replicating the tax efficiency from your personal name into a trust, for example. So already there, I would say that you don't really find much benefit between those two. So let's step away from that side for a bit and say that the tax efficiency isn't really the primary consideration. Asset protection, which is what we're speaking about, is a disaster in your personal name. Remember, you run your entire life. Everything that you do on day in, day out, it carries with it obligations, rights, duties. You are the most important thing that requires focus, requires attention, but requires protection. Now, as you're running your daily life, you're going to find scenarios. In your job, for example, something could happen that leads to some form of litigation or incurring some form of liability. Things like that are what we need to understand when it comes to doing things in your personal capacity. If you build up your empire in your personal name, all that's going to happen is one small little problem along the way could expose your empire, could expose your entire portfolio. So the asset protection is non-existent, and that is why typically you don't want to do something directly in your personal name. And so what would you do then? So we'd say, oh, what about a company? Let's just use a company. Everyone uses a company. We look at the JSE and they've got companies on the stock exchange and you're buying shares. A company seems pretty good. Why? In our law, what happens with a company is once it's registered, it's known to have limited liability. So these are limited liability companies. What that means is you can be a shareholder of the company, but you will never be liable for the company's debts, aside from the capital that you put in. So that is a risk that you face. The capital that you put into the company you may lose, but further than that, other liabilities you will not incur. So the company sounds pretty safe, because what it does is it puts your investment in it, and if something goes wrong in that company, they can never come and come after you in your personal capacity. Now, what people don't realize sometimes is that's great, but that's just one side of the asset protection reciprocation or coin, right? What about the other side? What's not protected is the shares of your company, because remember, you are still the shareholder. So again, we go back to you in your personal name where you're a shareholder. And by being a shareholder, these shares are being held in your personal name. And by virtue of that, what happens? They're not protected, because if something happens, if you have a car accident and your insurance won't cover you and you get sued because the person that you hit had a very expensive car and the repair costs are 300,000 Rand, there's tons of daily examples that happen. If that happens, your shares are exposed and your shares can be sold in order to recover that debt. So holding shares in your personal name isn't the answer either. So what is? So we have the trust left. So what's up with the trust from an asset protection perspective? Why then is the trust better than a company? Aren't these very similar concepts? No, not at all. So remember, the whole point of the trust was the trust was created in order to protect wealth, right? To protect the wealth inside the trust in order to make sure that the people that are supposed to benefit from it actually do benefit. So that's very different from a company, because a company is there to make profit, whereas a trust is there to preserve wealth and distribute this wealth for people's benefit. So it's got different protection mechanisms, and these protection mechanisms are what make the trust the ideal structure. So what we work with is something that's called a discretionary trust, and that just means that the benefits in that discretionary trust don't actually vest in a beneficiary until the trustees say so. This means that the creditors of the beneficiaries don't have anything to attach. So it's like being a shareholder in a company, but not having an actual share that creditor can come after. It's just a benefit that's contingent. It will accrue to you at some point, but not immediately. And because of that, holding shares, for example, in the trust is an ideal situation. Now remember, guys, this isn't a one-size-fits-all. We don't do this consistently that way. Some people may find that buying a property quickly in their personal name isn't a bad idea, because there's some strategies like flipping, for example, where that could actually work. Some guys, you may find that buying directly in a trust might benefit them in the short term, and it's one of their primary focuses from a tax efficiency perspective. Other guys building empires might want to consider a combination of buying directly in a trust and buying in a company that's owned by the trust. So this is not a one-size-fits-all, but there are certain considerations which for the most part would mean that the underlying vehicle that you would be using might be a trust. So how does financing optimization tie into all of this, and what does this have to do with a tax and legal firm? Well, it really doesn't, in the sense that it's not something that you'd find most tax and legal firms actually working on, but the reality is we work with investors, and we need to come to the realization that when it comes to wealth preservation, you cannot be efficient in what you do unless you understand everything that connects to it. A tax and legal firm would worry about asset protection and tax efficiency, and would not keep in mind the fact that if these don't balance with your financing optimization, you will be prejudicing yourself. So we brought in our partners, we brought in the experts, and we started consulting with them, debating with them, getting answers as to what it would take in order to be able to reach the perfect equilibrium between these three principles. Now, what's great is that with your perfect structuring, with being able to try and achieve a level of asset protection and tax efficiency, you can still get that financing optimization. Now, remember, from a financing optimization perspective, the one thing that you need to remember, and again, unfortunately, the way that the banks see investors changes from time to time. So at this time, what we find is that a bank will always consider your affordability when making an assessment. And because they consider your affordability in your personal name, there is going to be a cap, because you've only got so much income coming in, and they will only be able to give you so many loans. So what we do tend to find is if you run it in a business, if you run it in a company, for example, you're able to optimize the amount of finance you get from a bank, because you'll be able to do it in the company name, you'll be able to grow the company, make it a profitable company, and the bank will only expect you to sign as a surety for the debt, for the loans that it gives to this company. So that's an ideal situation, because that means that you're building this business and you're growing the business, buying property, buying shares, buying whatever investment you want to get into. But as you grow this investment, you're becoming more profitable, and you're able to get more money because you appear more profitable. And what this leads to is, in a few years' time, you've got a track record. From a financing perspective, people will start looking at this business and won't be relying on you in your personal capacity anymore. And that's the goal. So, firstly, you'd want to be able to buy in an entity and not in your personal name, because you've got a cap in your personal name. Whereas with the entity, they will look at your affordability, but you don't have any loans. which means that they'll look at they'll look at the company, they'll look at you, but since you don't have any loans, your affordability isn't impacted. You want to buy it in an entity so that after a few years you build up that track record. By building up that track record, hopefully you'll get to a point where the banks start looking at the entity and not necessarily at you. Even if you sign a surety, at least they'll consider the entity on its own because it's a profitable business. And so where are the downsides? How does this connect now to the asset protection side of things? So the problem that we tend to find is you want to be able to build up a portfolio large enough in order for it to be profitable and for these partners to look at you. You want your JV partners to look at your portfolio and go, wow, you're a really good business person, you're making a lot of profit, I want in. You want the banks to be able to do that. If you overprotect your portfolio by, for example, not putting your eggs in one basket at all, in fact, separating all your eggs across multiple baskets, the risk there is you're not necessarily building up an empire in one place. You're spreading it across, and because you're spreading it out too thin, it starts becoming difficult to obtain finance because you don't have one central place to obtain the finance from. So typically there's advice that we give and considerations that we have where we look at creating group structures, for example, or where we look at mitigating or doing a bit of risk management, assisting you in dividing up your assets across multiple companies, but not spreading it too thin, just dividing it so at least you can manage your risk. You've got your high risk in one place, your low risk in another, the ones that you can use to leverage and the ones that you might not be able to leverage very easily on. So there's a number of ways to achieve this. But remember, the goal here is you do not want to overprotect your assets and at the same time, because that will lead to your inability to obtain finance.